Welcome to the Supply Chain Pioneers podcast, where we highlight industry leaders on the forefront of innovation and technology in planning, procurement, and logistics. Hosted by your supply chain pro to know, Ulf Venn.
My interest in Japanese business, economics, and history is my segue into banking originally. I worked at 3 different banks, and so I always kind of had that spirit of entrepreneurship. As the technology boom was happening, it was very enticing. I'm most proud of being one of the founders and having been CEO for a long time and now executive chair of RapidRatings.
Supply Chain Pioneers is powered by Everstream Analytics. Everstream gives you the predictive insights and analytics to make your supply chain faster, smarter, safer, and leaner. Go to everstream.ai to book your demo today. Hello, everybody, and welcome to a new episode of Supply Chain Pioneers. And today with me, I have James Gellert, and he's the founder and executive chair of RapidRatings. Hello, James.
Hello, it's great to be with you.
And as always, we start with maybe a short introduction from your side so everybody knows who you are.
Sure. Well, I'm in New York, and I have been a banker in the early part of my career, turned tech entrepreneur with a through line of risk and financial evaluation as core elements of the things that I've done. And I'm most proud of being one of the founders and having been CEO for a long time and now executive chair of RapidRatings.
We're going to talk about all of that today and about risks that you might face in financial risk. So please stay tuned and really listen. Let's start at the very beginning and even before your career really kicked off, and that is your university background. Because as I did, you studied Asian studies, you were the focus on Japanese, I studied Chinese, and then this essentially helped you find your way through kick off your career, essentially. Maybe you talk a little bit about that because it really is something we have in common.
Yeah, I love that we have that in common, and I appreciate your asking about it. My start in Japanese and Asian studies was probably mostly because I was terrible at Spanish and French in grade school, and in high school. When I got to college and I had a language requirement, I had already been studying Japanese history and was really fascinated by it. So I thought I would dive into Japanese as a language, and ended up becoming my minor. And I spent my junior year in Kyoto studying at Doshisha University. So it's been a central part of my life, and ended up becoming something that I really took to and loved doing. And it was my segue into banking originally. So I sort of credit a lot of my beginnings in work to my interest in Japanese business, economics, and history. And in fact, that actually led to my first work. But even though today what I'm doing is not directly tied to or directly in Japan per se, there are a lot of the learnings and the cultural appreciation and things like that were really central to my career as I've grown.
Yeah, actually pretty funny. I also started because of my interest in the modern Chinese history. I read a book in school about it, and then I also had to pick something, and that sounded interesting enough that I wanted to explore it more. So pretty cool.
I love that, and of course the difference in our ages, Ulf, is that when I was in school, the Japanese economy was the massive driver, and China was really far behind, and it was the students who were going for Chinese, all the students who were going for Japanese looked and said, "Oh, that's what a silly idea that is." And then, of course, there was only about five years later, and then continuing, where Chinese has been clearly a very logical path and a really, really fascinating path for all of you who took it.
Okay, let's move on to the next stage, which is the start of your career in banking. So from early on, you had a focus on debt and financing, and you also have been very widely successful there, right? You quickly made it to a VP. And at one point, you then started to actually pivot your career out of this banking sector after being so successful to start as a CEO in different wireless and technology companies. So why did you do that switch? And why was it directly after the dot-com bubble burst?
So the capital markets activity that I did, the debt financings were all international. And I worked at 3 different banks, and the most recent one, Deutsche Bank, I ran a group called the Yankee Origination Group. So it was basically bringing non-US corporations, financial institutions, and sovereign entities into the US market to fund. And through that, because I worked for European banks doing this in the US markets, there was a big entrepreneurial component to it as we were competing with the Goldmans and at that time the Solomon Brothers and the Merrill Lynches and Morgan Stanleys and the big so-called bulge bracket investment banks. And so I always kind of had that spirit of entrepreneurship, even though I was working at large banks, but I was doing it in small groups that were growing and competing really heavily. So I had that in me, and I loved banking. I loved the work in representing different companies, understanding them, getting under the hood, understanding and meeting management and talking with them, and then advising them and helping to construct different securities that we could sell in the U.S. markets. But as the technology boom was happening, and we got close to the bubble, it was very enticing. The idea of leaving banking and getting into entrepreneurship outside of the comfort of a larger organization was sort of a siren call that I was really excited about. And while I would love to, particularly the way you just kindly phrased that question, I would love to look back and say, well, when the crash happened, the bubble burst, I saw this great opportunity and I jumped at it. In fact, I left Deutsche Bank, I resigned about 2 weeks before the bubble burst, and I started my first company right in the midst of it. And that was a really interesting learning experience. But I can't look back and say that I was particularly prescient about coming in at the low. I came in at the high, and 2 weeks later it exploded. But I'm very happy that I did, and was happy I did then. But it was interesting timing.
Yeah, I looked at that and also thought it's interesting, but now it's even more interesting, right? Because it actually is exactly the other way than I thought. Anyway, great story. So you have been a CEO for many companies in that time, right? Tried to really get a footing in the technology space. At one point, you then decided to co-found Howland Partners, and which later on became Howland Securities, and you provided advisory to banking institution and technology companies. So taking the learnings of both fields you have worked before and putting them together. So as a lot of startups are also listening to the podcast, and one of your advisories was capital raising. Given your experience, what are the top 3 things to consider when you're looking for capital as an aspiring CEO?
Well, I think for any company that's raising capital, whether it's early stage or later stage, you have to start by having either pulled together a high quality team. The team is absolutely essential. And if you're at such an early stage where it's really a person or 2 people, you need to be able to demonstrate the plan to source, recruit, retain, and grow really good people. Because the cliche that companies get invested in because of the technology is not always right. It's really the people, and the people who are controlling or building the technology. So the people are incredibly important. I also think the ability to talk about the pros and cons, or the strengths and weaknesses, or the opportunities and the challenges, but to be able to talk about the balance of challenges that you're going to have is really important. A circumspect and well thought through communication is critical. And most investors, whether they're angel investors at the early stage or they're larger institutional investors, they don't want to just hear this incredible vision. They want to hear the vision with the backup of what could go wrong and how it's been thought through. The third thing is really about telling the story. And I've got a very close friend, a gentleman named Adam Epstein, who is a longtime investor and author on corporate governance and is an advisor to companies. And he really pushes, and very rightly so, has been an early proponent of the story. So many companies, so many management teams come out and talk about the thing that they've built without being able to tell a cohesive story and a coherent story to investors. And that doesn't mean making things up. On the contrary, it means giving something that really makes sense. So I think you've got to have good people. You've got to be able to talk about the pros and cons and that you've thought them through, and you've got to be able to communicate well and in an honest, a true, a genuine, and a thorough way.
Like this conversation, honest, true, genuine, and thorough. So, and that's why we move on, because thank you so much. That was great. To the next part, which is you now are in Howland Securities. You have actually acquired a broker to build that company. But then 1 year later, after you already were doing a big merger, you started acquiring another company and then even being the CEO of that with RapidRatings. So why did you take that upon yourself? It must be passion, right? You saw something that really perfectly connected and you thought, okay, let's go for it.
That's basically right. Howland Partners and Howland Securities were and ultimately was an entity to help advise companies and to raise capital. And our focus was really on what's now considered fintech, and then had an element that was independent research as well as technology and financial services. And so that was our focus. So the clients that we were representing there were kind of all in that world. And it's also really important that when I say we, I explain that I've had a partner, Douglas Cameron, for now 24 years, and everything that I've done since banking, we've done together. And it's one of the great aspects of my personal and professional history that I've been able to work so closely with someone who has become a wonderful friend, but also someone I respect immensely professionally. And so when we were focused on Howland, RapidRatings came along, and it was the kind of company we would have represented. And in fact, we were approached to look for a buyer of the company. So the owners at the time were looking for a sell-side M&A banker and approached us because they had heard that we had a specialty in the space. And as we looked at it, we kind of had that light bulb that went, well, we're dumb enough to do this, so why don't we try this? Because as we got to know the company better, we thought the diamond might have been a little bit rougher than we thought, but it was bigger than we thought. And the idea of getting into the ratings space with a non-issuer paid, so not like S&P and Moody's, but a subscriber paid, a user paid model, that was really interesting. And that RapidRatings was a quantitative system for evaluating financial risk, we thought was extremely valuable and useful in a whole bunch of ways. It ultimately really paid off, particularly in supply chain. But we thought this would be something that we should buy ourselves, and so we did. And we really kind of ran the two of them simultaneously for about a year as we wound down and completed the deals that were in the investment banking boutique, because we really wanted to focus exclusively on RapidRatings, and that's really ultimately what we ended up doing.
Perfect segue when it comes to supply chain, because you already mentioned it. My next question is around that. So you obviously, with your banking background, a little bit dabbling in the fintech space and technology, you probably didn't have too many touch points with supply chain before, and all of a sudden there was a big customer group of yours, right? So how did you start thinking about supply chain when you first heard about this? And how did your, I would say, conception of what a supply chain is change over time?
Originally, I thought RapidRatings would be about 75% financial services clients and 25% corporate clients using us for counterparty risk management. And by counterparty risk management, I mean looking at customers and clients on one side, traditional sort of credit and finance work, and on the other side, suppliers. So it stood to reason, particularly after the financial crisis, which was right around the time, just to continue my major career changes, being aligned with major crises. We bought RapidRatings and then immediately went into the financial crisis. It was clear that companies were going to need to understand the businesses that they worked with better than they ever have before. So that seemed obvious, though in supply chain was still risk in supply chain was still a relatively young sub-discipline within supply chain. And of course, things like compliance and quality and delivery and all of the traditional logistics aspects of supply chain have been around for a long time. But financial risk in supply chain tended to still be something that people would just look at payment scores and say, all right, well, the suppliers paid their bills, so they must be fine. And that's an inadequate, ultimately, it's an inadequate element or way to evaluate a supplier. So we thought there was a different way to do it. And supporting us in this was that supply chain risk became a big area. And it became a big area really for the last 10 years, 12 years, something like that. And it has grown and it's grown and it's grown. And as more technology has come in to help supply chain, as more risk domains have been in focus by boards and therefore finance organizations and therefore budget and therefore procurement and supply chain, things like cybersecurity risk, more recently ESG, and certainly financial is something that has just become more and more important. We had the idea, and it's fully been vetted out, that financial risk is an underpinning one to all of these others. And if a supplier is weakening from a financial health perspective, they can't be good at all of these other things. And if they're strong or improving in financial health, they have the ability to be stronger in all of these other areas. So that was just something that we thought made a lot of sense, and it is really borne out beautifully.
Yeah. And did you find any surprises when you looked at when you started talking to the supply chain professionals? Were there any surprises when it comes to the complexity you saw in supply chains, or how their work actually went on a daily basis in what you would have perceived from the outside?
Yeah, I think the biggest surprise has been that there is a real range in sophistication of supply chain risk organizations, or put another way, the elements of supply chain risk are really quite different in different organizations. Some are real sophisticated. Some are on their path to becoming more sophisticated, and some are kind of living in a world where they think, well, we haven't had a lot of problems, so we're probably doing it well, which is frankly unsophisticated, and it works until it doesn't. When it doesn't, it's a giant blow up. People lose jobs. It can be a disaster. But where a company is on that spectrum is not at all connected to what their external perceived sophistication as an organization is. I can put it another way by saying you can take the Fortune 1000 and you could say, well, the top 500 must be the most sophisticated. And it's just not that way. Many of them are very sophisticated. Many of them have become much more sophisticated, but the size of the organization and its status as a public company doesn't necessarily mean it's going to be. And that's been something that we've needed to learn over time. One of the most fascinating parts to me of supply chain risk for the financial side is finding out that across all companies, really all sizes, about 75% of their suppliers are private companies. And when private companies are the ones that historically have not disclosed very much, particularly financial information, it means that 3/4 of most companies' supply chains historically have been this giant black hole where they just don't know how well those suppliers are doing, yet many of them are critical suppliers. So that's an area we've really tried to focus on, and it's become one of the central elements of value that RapidRatings provides. But all that's been really interesting, and I've learned it along the way.
So looking at RapidRatings, you alluded to the financial crisis, but were there other pivotal moments that really changed RapidRating as a company, either from a growth perspective or from a focus perspective?
This focus on private company ratings has been the most is the seminal moment in our history. We always knew that the algorithms could rate public and private companies on the same basis, but that presupposed you had the private company financials. And I remember it's got to be close to 12 years ago now when we got a call, and this has been discussed publicly, so I can say it, but we got a call from someone at GE corporate at the time, and this gentleman called and said, we need across all of the business units to evaluate our private company suppliers better, but we can't staff up to try to chase down and ask each one of the private companies to supply their financials, and it's hard, and so on and so forth. So what can you do about that? And they had heard about us from, I think it was Gartner, and so they heard, and it was an inbound call. And basically at that moment, I said, we'll go out and get them for you. And so, 130,000 some odd private ratings from 140 countries later, we began soliciting private company financials through our system, which is a combination of technology and people, on behalf of our clients to get confidentially the information that is needed to do the financial health evaluations. And that was something that started as an inbound call, and I went, yeah, I think we should do that for you, for GE, and that has been one of the real central value propositions of the company ever since. So that was the biggest. The other is that we were fortunate to find some wonderful financial backers along the way, and they helped us to expand the company. And again, it's about people. So with that expansion, we were able to continue to add really good people and grow the business.
Looking at suppliers providing, and then also looking for their financial information, I do believe that when you think about it, it makes sense that you need to get the data, right? But then the process of really getting data and having suppliers share additional information with you, right? Even if you come on behalf of a customer, that wasn't standard practice at that time. So it essentially was evangelizing to them what you're trying to do for your customers. What was that experience like? Because I can believe that can be pretty tough.
I'll tell you the best example of, or illustration of, the fact that it is tough is that no one else has done it successfully other than us. And so we've created this moat that has given us this protection as a business as we grow, because it is really hard to do. But we capitalized on something really important, and that is the theme of collaboration. And it sounds light and fluffy for a company that is about quantitative analysis and a technology company, but it's true that helping to facilitate the collaboration between clients and their critical suppliers and being able to demonstrate to those suppliers that there is an advantage in a commercial value to the disclosure, as long as it's kept confidential and it's protected. And we've spent a lot of money and a lot of time and thought into making sure that that happens. But they're knowing that the disclosure is part of building the strong relationship with their client, their customer that they want, and helping our large enterprise clients realize that you can't take this financial information and the analysis of a supplier and use it against them, right? That is a quick way to not get to not progress a program. But if you're using it as a means to communicate with them and as part of the evaluation process, it can be a really powerful relationship builder. And that's something that took time, and you use the right word. We still have to evangelize that. I mean, it is about proselytizing and communicating and providing thought leadership and helping to coach everyone about it. But it has become such an interesting central part of the success of RapidRatings, and frankly, of my professional career. So my development as a person in this space who talks about the opportunities, really recognizing that this is an important part of it, and speaking to both sides and speaking to the market about it has been both interesting and fascinating. It's also been enriching because it has put me in a position where I feel very fortunate that I've been able to talk to a lot of our clients and their suppliers about the opportunities for doing more business together, and doing it, even if a supplier is not doing well financially, the more they're communicating, the better off it is for them. And I can speak to them as a private company owner and as an entrepreneur, and I think that helps.
You have worked when it comes to debt or also financing already in that space. And we have seen many companies actually with very successful turnaround strategies after even a bankruptcy, right? So it's not the end having no money for the moment. If you have a strong product, might be that you always can achieve a return, essentially.
And back to one of your early questions, a supplier that is not doing well, if they can communicate a cogent story and explain what they're doing in the business, and be honest about the pros and the cons of what's going on, they're the ones that are going to survive the best and are going to capitalize on having good clients who want to understand them better. Right. So it really is about, pulling the pieces together and being able to communicate the story. But for most of the Fortune 1000 type enterprises, they don't have the ability to speak to 5,000 suppliers, or even in many cases 500 suppliers, to understand their story as well, which is where RapidRatings has come in to be able to bridge that gap really well.
It just came back to me was a story about a German company that helps with producing paper. So essentially, they build these big, giant steel presses that help make the paper, so the round presses. And they're market leader in their space. But because of some issues, they went out of liquidity, and they had to close down the plant. And then on the last day, the employees all went to the same bar everybody was going to after work anyway. And they were contemplating there with the barkeeper around their work, what they did there every day, and how sad it is that it's gone. And then the barkeeper took that information, put it into a cohesive story, and found a consulting company that then helped them find an investor. And it all was based on this guy talking to the people in the bar about what they did on a daily basis, how valuable it is, right? And the management was not able to find somebody, but because of the good storytelling, all of a sudden they found an investor. Yeah.
I love that story. All aspects of it, not the least of which is that it can be really productive to go to the bar.
Yeah, I mean, it's about exchanging ideas, right? And sometimes you take information from various places and all of a sudden it just clicks, right?
Yeah, and I think that's even more important in an environment like the one we're in today, where there are so many factors that have been affecting companies positively, but many negatively. The COVID crisis, this sort of more post-COVID crisis period, supply chain disruptions, and certainly global geopolitical risks and disruptions. All of these things are affecting companies more than maybe ever before, but certainly the more global supply chains are, the more companies are exposed to all of these problems, and it is the communication about them that is absolutely critical. So I agree. It's an interesting and necessary time for that kind of communication to be a part of supply chain risk management.
Yes. Talking about interesting times, we are in an economic downturn, and financial health, obviously, in situations like that is becoming a really important topic. So what are like key areas or even key regions that you see already as a major concern or might see as a major concern coming up in the future? And will a big bankruptcy wave actually come?
So I think less in terms of the geographic challenges or the industry challenges as I do the segment of companies. And when I think about the larger companies versus the smaller companies, or often it's public versus private, that's where I think we've got the biggest challenge over the next couple of years and where we are likely to see the most disruption. So many public companies have continued to have access to capital through this contracting and turbulent credit market that we've been in, where private companies and smaller companies have had a harder time. And there are a couple of reasons for that. So really quickly, we've had a low interest rate environment for now well over a decade. And that was first the quantitative easing as a result of the financial crisis, and then it was the government stimulus funding and support with the COVID crisis. But it has created what is essentially a 14 to 15-year period of extremely low interest rates, where investors have had to go down and invest in weaker and weaker companies to get yield that they historically would have liked. So that has supported weaker companies. And there have been more investors in credit. So you've had more credit availability for more types of companies. And you've had banks that have had a period of relative boom. So they've been able to continue to invest in or lend to private companies and middle market, smaller companies. The challenge to all of that is that it has meant companies have sustained themselves for a long time on this ability to constantly raise money at very cheap levels. With a contraction in credit, with higher interest rates, combined with inflation that has hit particularly the middle-sized companies and the smaller companies harder than the larger companies, because their costs of capital, of course, are higher, but their costs of labor, their costs of parts have gotten higher, and they haven't been able to pass all of those through. So what you've seen in this economic boom, if looked at by the stock market, for instance, because everyone says that things are great because the stock market's doing well, what you actually see are larger companies have been able to survive and thrive, whereas the middle market and the smaller companies and private companies have been squeezed a lot more. That has created a period where many of those companies won't survive. And some of them will just fail. Some of them will have to be restructured. Some of them will have to sell themselves. So there'll be more M&A, more private equity investment, and so forth. But all of that creates sort of under the surface a different environment than people have seen before. And we've heard it recently being referred to as a riptide economy, where there's this undercurrent that is pulling businesses in a bad direction, sort of out to sea. And we partnered with a fund called Marblegate that did a really interesting study using our data with us to look at middle market companies, and the disparity between middle market companies and larger companies is radical. Significant decline in operating and net profitability, significant decline in liquidity, big increase in leverage. And you look at all of those things compared to the public companies, that's where people need to focus. And then you add the geographic risk that comes from multiple massive hotspots around the world and supply chain disruption that are tied to those. It's going to be a period for the next couple of years where we will see more bankruptcies, but we're going to see it for a variety of reasons. The amount of debt companies have being one, and this phenomenon being another.
So do you think that people monitoring the space are actually well prepared? Because frankly, a lot have probably never been in a situation like this here.
Yeah, no, it's a good point, because I think a lot of companies have gotten better. They've gotten smarter. They've put in technology. They have adapted their processes to use financial health evaluations or to use other technologies available to them so they can scalably monitor more risk. But you still have a phenomenon that a lot of the people in these companies have come into their roles in the last 10 years. Or looked at another way, they weren't in their roles in the last credit downturn and post the financial crisis, or in any end of a credit cycle. So there are a lot of people trying to manage risks who have never had to manage the risks that we have today. And that means they have to be more clever. They have to be more curious. They have to adapt and use technology and rely on thought leadership of third parties like RapidRatings and others to assist them. So it's an interesting time, going back to the fact that 10 years ago there wasn't a lot of risk management in supply chain. This is an opportunity for supply chain risk management to go through a whole nother growth period and evolve, which is going to be exciting to watch.
Yeah, maturity is going to happen, right? If they want to or not, because they're going to have to manage a crisis every now and then.
That's exactly right. That's exactly right. Baptism by fire.
Exactly. Very good. So we now have gone through your whole career from the very beginnings to today. Now you're the executive chair of RapidRating. We have understood how you got there. And frankly, looking at it, it just looks like a logical evolution step by step. But has it felt this way all the time?
No. I love looking back now, and I appreciate your helping me look back and think that there was this really logical through line from the beginning till now. The reality is that most people don't get that opportunity to just do this, long-term, many decade sort of plotting out and have it be a straight line. And that's fine. That's fun. There are themes in what I've done, and there are themes in the businesses that I've been involved with that are exciting, but it hasn't been perfectly plotted out from the beginning. That said, some of the most consistent pieces are that I've enjoyed entrepreneurship. I've enjoyed building businesses. I have had wonderful business and personal partners that have been, central to my being able to succeed and our being able to succeed. And I hope that whatever the next chapters are, I'm sure we'll continue to have those themes, because they're just makes everything more fun.
Do you also think your having this partnership gave you overall more confidence to take more risks than you would have done otherwise?
Yeah, it's a really interesting question. I think it must. My longtime business partners and colleagues, and most specifically Douglas, has always been a wonderful ballast, and in many ways more conservative than I am. But then in certain things, I've been the more conservative one. But I think being a good entrepreneur, you've got to be able to take incredible risks in as conservative a way as possible. Because particularly in the industries that I've been in, because there's some balance there. And I'm sure there are things that I've been too conservative about, or I could have taken more risks, and there are probably risks I maybe shouldn't have taken. I don't know. But, you never really know those things. You just try to make the best decisions possible at the time with the information you've got. And certainly having a trusted partner has helped me to do that a lot.
My last question always is around hobbies or other things that kind of stand out. So today I want to talk with you about the young audience's arts for learning, which is where you are a national board member, and they are looking to advance artistic and educational development for children and youth by bringing together professional artists of all disciplines to learn and create and participate in arts. My simple question here is, because that sounds like an amazing cause, why is giving children access to art so important to you?
So I've been involved in this organization now for pretty close to 20 years, and it's the oldest arts in education nonprofit in the US. And it has gone through a variety. It's evolved a lot over time. There are 30 affiliates around the country. So we are providing services and these educational elements to kids, around 5 million, in some cases 6 million, or some years 6 million kids a year. But the gist of it is to use the arts as a way to help kids learn other things. It's not just about letting them learn how to play an instrument. It's about helping them to understand problem solving differently and to reinforce their reading comprehension and their math skills and science. And it's that's why we call it arts in education as opposed to education of arts. But ultimately, it's about giving kids the ability to think broadly and to become critical thinkers and to have more empathy and to be exposed to things outside of the traditional day in, day out school stuff. As an entrepreneur, as a business person, as someone who has enjoyed the path that I have enjoyed, I think those are really critical elements that every kid should have, and that if we can do something to help the next generation be better thinkers and carry more empathy with them as they grow in their lives, that's about as wonderful a goal as we can have. And it will help many of them be entrepreneurs. It'll help many of them just succeed in anything they want to do by having a broader, more rounded education. So I love it, and it's wonderful people, wonderful goal, and it ties into a lot of the things that I've done professionally.
And it shows, again, it makes sense to ask these questions at the end, because I couldn't follow this up anymore. It's just a great cause and a great ending to the episode. And with that, James, thank you so much for being here and sharing your story with us.
Well, thank you very much. This has been a wonderful time, and I really appreciate it. Thank you for your thoughtful questions.
And with that, everybody, I hope you enjoyed the episode. Please follow James on LinkedIn, where you don't share so often, but what you do is quite in depth. So I would definitely recommend to give him a follow. And with that, I would like to say bye-bye.
Bye. Thanks again.
This was Supply Chain Pioneers. Thanks for watching, listening, or however you are enjoying this podcast. You can find Supply Chain Pioneers on Spotify, Apple Podcasts, all other major podcast players, as well as on YouTube at Ulf Talk Supply Chain. Please don't forget to like, subscribe, and comment. See you next time.